the new culture that we're witnessing now is a culture of returning more to investors than it is a culture of growing production. And that requires more financial discipline.
And now let us bring in our special guest, Abdulaziz. I'm pronouncing your name wrong. I apologize, but thank you for being here. Appreciate you.
Jim. Hello, Tracy. Thanks for having me.
Yeah, our pleasure. Our pleasure. So we have interesting timing. I love that you're here on the day that President Trump and his secretaries are visiting the Middle East. I think they're going to land in Saudi Arabia maybe today and visit Saudi Arabia, UAE, and Qatar over a couple of days. What's the expectations there with respect to this visit?
Well, there's a lot of expectations, particularly on the geopolitical arena. The past couple of years have been quite rough for the Middle East. This region has been through a lot, whether it's the Red Sea, what's going on up north, or even what has been going on in the commodities markets, oil passages, as well as global trade. And so there's a lot to be discussed in that geopolitical space, but there's also a lot of issues to discuss in terms of how to move forward with employing a larger scopes of cooperations between the GCC, the Gulf countries, and the United States. This is a new chapter. This region believes in elevating this relationship into new highs and possibly develop new strategies to align with the United States vision and leadership.
Excellent. And I kind of want to move to OPEC Plus here because they have decided to increase production from those voluntary cuts. There are a lot of rumors going out around on why this is happening, from they want to flood the market to they want to push shale out to they are want to reprimand the cheaters, particularly Kazakhstan. So really, tell us what's really going on here.
Well, the first thing that I keep hearing about the timing of these comebacks of the cut barrels and putting them back on the market is it couldn't be a worse timing. When in fact, in my view, it couldn't be a better time because in navigating through the uncertainty, whether it's the Liberation Day that kind of casts a shadow on the commodity markets and the macroeconomics in general, or looking at how oil has reacted to these news, it was that time that required more certainty during a time of uncertainty. And if you look at the fundamental, the supply and demand, and how the fundamentals of oil markets have been, they've been quite strong, to be honest. And the inventories, given how low they are, could accommodate more supply. And that's why, in my belief, OPEC had to deal with the issues. Issue number one is the external, and that is the macro, the economics. How would global economic growth be maintained? And then the internal, being the cohesion of the group, as well as how the non-compliant would be compliant to the production levels that they've been required to be at. And that's why both in the April meeting as well as the May meeting, there was a decision to put more barrels on the market. Initially, during the days of the announcements, the sentiments were quite negative. But today, we're looking at oil prices wiping out global offers that were taken during Liberation Day. And so I think this is very healthy for the fundamentals. There are typical, if you want to look at the fundamentals, they remain very strong. OPEC Plus as a date had committed to meeting every month to review the data and speak the language of the data instead of speaking the language of the sample.
Absolutely. Smart, very smart group of people over there. I will have to say it was very impressed. I got a chance to meet you in February, and we were at an OPEC meeting together, and it's just amazing the amount of detail and the amount of records they keep. It's amazing. And I want to move over to shale right now. We've had a lot of earnings come out, and a lot of companies have said oil prices are too low. We're either cutting back on production or, we're envisioning, lower CapEx. Some are cutting CapEx altogether. So what do these lower oil prices kind of mean for shale? And do we see kind of shale hitting a peak this year and maybe flatlining? Well, it's actually been flatlining for a few months, but do you think we've kind of hit a peak here in production?
Great question, Tracy. Over the past 24 months, we've witnessed a great deal of consolidation for the shale producers. And that included big producers, medium sized producers, as well as small producers. And that consolidation wave had produced a completely different scene for the US producers. Now, the new culture that we're witnessing now is a culture of returning more to investors than it is a culture of growing production. And that requires more financial discipline as well as sticking to price ranges that secures these returns for investors. We lately have been witnessing as well that the share producers are far more commodity price sensitive than any time before. That pushes the producers to adopt this culture of maintaining the returns for for the investors for as long as possible. And that requires even more discipline both in OPEX as well as CapEx. This is not the culture that we are used to see back in 2018 or 2019. It's something new, but it also pushes the North American price range to be bound between 60 to possibly $70 a barrel. And that, in my view, what we are going to be witnessing coming from the US.
Just to shift gears a little bit, I noticed there was on the agenda for the meetings these next few days, there was a significant time allocated to the discussion of the green hydrogen projects that are being developed in the Middle East, is particularly with respect to maybe creating a distribution channel to Germany to help offset, a Russian gas. And it seemed like a big deal on this green hydrogen. What's the status of that in the mindset of that project?
Well, for Saudi Arabia in particular, the hydrogen projects are very prosperous. And Saudi today remains the lowest cost producer of hydrogen, particularly green hydrogen. And that gives it that advantage and leverage. But the problem with hydrogen is that the momentum of the growth for a hydrogen market is not really picking up as much as the global climate ambitions are looking for. And that's why we don't really see much potential for a fast growth. There is growth for market for hydrogen, but it's not the same momentum that was anticipated during the time these hydrogen projects were proposed or started to be initiated. Now, no plans have been delayed or canceled, but globally we witness as well that hydrogen is struggling with other issues of efficiency as a fuel. Not only is it difficult to get that type of energy from hydrogen into industrialization, but it's also difficult to transport it and handle it, to build an engineering plant to handle a hydrogen transport and keeping the temperature available to maintain in safe practice for hydrogen. That's why the projects are rolling as scheduled, but finding the market to sell the hydrogen produced is the bigger challenge in my view.
Yeah, and it seems like it just from my seat here in the States, it seems like the decarbonation initiatives are less important now than they were, say, 6 years ago. Do you feel that that's true globally?
Oh, absolutely. The past 3 years, this whole climate agenda have been driven not by engineers and scientists, but by those who have that ideology of getting this agenda. And that's the problem we continuously come to see, whether it's the late 90s or the 2000s. These waves keep on coming, and every time it's pushed through ideology, they don't really survive. It's only when the economics make the case that it becomes more viable, more available, and more practical.
Yeah, that totally makes sense for sure.
Any final words for us
Well,
that we
final
didn't get to
words
cover?
is trust the fundamentals. Trust that what is being reviewed is what is going to reflect on the commodities. If you follow every sentiment, you will be lost very quick. So keep your composure by following.
Well, thank you so much for being here, spending this time with us. Wish we had
Thank
more time. I have a million more questions. So thank you so much.
thank you, Jim. Thank you.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.